Hello and welcome to the CX Files for July 23rd, 2026. My name's Mark Hillary and I'm in Sao Paulo, Brazil.
And I'm Peter Ryan in hot and humid Montreal, Mark. It's good to see you and very excited to catch up with you today about a topic that has been on the tip of the tongue or the lips of many people in our space. And that is the issue of publicly traded companies. What's going on when it comes to BPOs that are listed on the various equity markets around the world? Because I think we can agree that, well, not for every BPO, but for a lot of them that's publicly traded, it's not been the easiest of times the past couple of years.
No, that's absolutely true. Certainly, if you look at all the big guys that are publicly traded, there's been some enormous losses in the last sort of
Yeah.
3 years or so. I think if you bought any of those companies in 2022, then you'd probably be looking at 10 cents on the dollar today.
Yeah, unless you sold short, you're in big trouble. Listen, I had the chance to catch up with a longtime friend of both you and I, as well as a longtime friend of the podcast, Jim Farnsworth, who is the founder and principal at HiOctayne. Now, Jim's based in Denver, and his pedigree knows no bounds when it comes to our sector. He's worked for many different publicly traded companies in the past, and I didn't think there'd be anybody better than Jim to talk a little bit about what some of the challenges are for publicly traded firms in BPO. We dive into a lot of things. We dive into the impact that the AI hype cycle has had on publicly traded outsourcers. We talk a little bit about the valuations that outsourcers are dealing with right now and how that's impacted share prices, and a little bit about what firms that are publicly traded might want to think about in terms of looking to try and restore that investor confidence. Because when it comes right down to it, it is investor confidence that so many of these firms are taking a hit from right now. There's not been a tremendous amount of innovation, at least in terms of how they're presenting themselves to the market, and that's being reflected in share price. And in my view, what you just said about buying a particular share from a particular company and being down to 10 cents on the dollar, that's frightening. And it's not a sustainable level of support from investors in the space.
I think that one of the big problems here is that the message is being defined by the investors, by the short sellers, by the analysts, and the BPOs themselves are not really sort of telling their own story. I think that, especially the big guys, they should have the resources to be out there, shouting from the rooftops and saying, look, we understand. We understand that you've got a lack of confidence in our ability to change. But here is what we're actually doing, and line up a sort of ABC. Here's the roadmap. This is what we are doing. And if they don't do that, then they're just allowing their own industry to be defined by the investors.
Exactly. If I remember correctly, it was that story about the fintech firm in Scandinavia that said that they were getting rid of all their agents and they were going to replace it all with AI automation. And that was going to satisfy what was going on in regards to how they were going to manage customers. And then that's when pretty well every share price of every publicly traded CX services firm started tanking. And I agree. These companies have to fight back. They can't allow outside parties to define their narrative. And hopefully, if they think a little bit about that and they listen to what Jim's thoughts are over the podcast today, this might be a catalyst for it. So let's head on over to our chat with Jim Farnsworth from HiOctayne and find out a little bit more on this very scintillating subject. I couldn't be more excited to welcome back to the CX Files a longtime friend, a longtime confidant in our industry, and some might even know a former boss, Mr. Jim Farnsworth. So, Jim, welcome to the podcast, and it's great to have you back as a recurring guest on the CX Files.
Peter, thank you so much. It's always a pleasure to be here with you and of course giving my best regards to Mark as well. So thanks for the opportunity.
No, no, thanks to you for taking some time and joining us. And, Jim, one of the reasons I wanted to have you back is because I think you've got a very unique perspective on a topic that has been coming up quite a lot recently. And that is the issue of the performance of publicly traded outsourcing firms that specialize in customer experience management. I can't remember a period in which there's been so much chatter around what's going on. Why have share prices for so many organizations, legitimately not all organizations, but so many that are publicly traded, taken a nosedive the past few years? So, given the fact that you've worked for a number of outsourcers that are traded on various exchanges around the world, we thought it would be a good idea to bring you on just to get your thoughts and your angle and your point of view about what's happening and maybe what some of these firms that have had some challenges in this regard can maybe look to turn things around. So if you're
Yeah,
cool with it, we can just dive right in.
yeah, sounds great, Peter. I appreciate that. And I think you're right. You've seen, if you look across the stock market listings at the BPOs that are publicly traded, you'll see pretty much all of them are down significantly over the last 2 to 5 years. Um, Post-COVID period, I guess, for lack of a better term. And as you pointed out, not all of them, but
Yeah,
a
a
significant
good
number of
number.
them are. And some of that is because the lag on the industry, which we'll talk about here in this conversation, has an effect across all companies. But certainly some of it's also driven by individual companies themselves and their financials. I think you and I both know that it's better here to talk about things on a macro level than,
Yeah.
we're not going to talk about a specific company who might have a specific issue. But, there are certainly some outliers that have grown, which is encouraging, but by far the majority are shrinking significantly. I mean, more than 50% valuation declines in the last 5 years.
So, Jim, give me a sense from where you're coming from as somebody who's worked for a lot of publicly traded companies, as somebody who's got a strong background in CX for a few decades, not to date you or anything like that, but the reality is you've seen it all. You have seen this industry from the inception phase all the way through to, I would say, probably peak labor arbitrage. And now we're at a point where there's a lot of disruption in the market, and that's having a profound impact on share prices. Broadly speaking, what do you see as the key influences in terms of why shares have been so volatile and in so many cases churning downwards the last 3.5 years?
Yeah, Peter, investors are really they no longer see most of the BPOs as growth companies. They're increasingly seeing them as labor arbitrage businesses whose core revenue stream may be disrupted by AI, which I know we talk way too much about, but it is definitely the number one factor. And if you go back 5 to 10 years ago, investors were generally pretty excited about the publicly traded companies, and we all know that we can name the big names, which we're not going to do. But they saw them as beneficiaries, of globalization, of digital customer experience, of increasing CX complexity, recurring enterprise contracts, which I know I used to always see as a huge part of the growth when I was specifically in the industry. And all along, it's never been the most exciting or sexy industry, but it's always been very predictable. And then all of a sudden, AI shows up, and I think the first earthquake really occurred back in February of 2024 when Klarna went public and announced in a major media blitz that they were going to be able to take 2/3 of their workforce and replace human beings with AI exclusively, and therefore the waterfall just started for share prices of BPO companies. Now, interestingly enough, even though Klarna came back in May of 25 and said, well, maybe they admitted, well, our rush to cost savings maybe didn't take into account all the difficulties, and they backed off on that somewhat, but they still have a net reduction in human costs versus the cost they were spending on AI. So, that really switched the narrative and the industry analyst into thinking, wow, our call center is becoming obsolete. And I know a lot of people in the industry probably said the same thing. So, whether or not that's long-term true is sort of irrelevant in the scope of your question, because the bottom line is the narrative changed. And once the narrative changed, there has been no going back since then.
Yeah, no, it's true. The narrative is important, and a topic that you and I, or not a topic, but an expression that you and I use quite a lot in the course of planning out the podcast was storytelling. And storytelling is important, especially doesn't matter if you're an individual investor, a fund manager, a broker. And I say this as somebody whose dad worked in investments and finance for 50 years. The storytelling around a company or around an industry is very much a factor in terms of the extent to which somebody, an individual, or an organization is going to choose to invest in a publicly traded firm. So when we think about it in the context of storytelling, Jim, why has the investor community seemingly abandoned the front office BPO sector? When we think a little bit about that confidence that I think so many investors had, whether they had in-depth knowledge in our space or whether they were just casual investors, there always seemed to be a set view that, well, it might not be flashy or dare I use the word sexy. It was always consistent. That seems to have evaporated.
Yeah, and I hope it's okay that I use the word sexy first. I'll
That's
let you get
scary
away
that
with
we
it.
both use that word in less than 30 seconds
Yeah,
of each other,
exactly.
but
Isn't
you
it?
know what? I'm not going to
Isn't it?
comment.
Yeah, fair enough. Well, why did they become nervous? They became nervous. There's probably 4 or 5 factors. I mean, one would be that, AI, which gets so much attention and is definitely the darling of, the stock analysts and Wall Street and that kind of thing, not just in CX, but everywhere. But it really, at least in perception, attacks the core revenue engine, which is human beings doing services at large scale. And, they that has always been something that there was always more customers calling, there were more agents, there was more growth, more programs. And now, the AI threatens that in the eyes of many. They see chatbots replacing inquiries. They see AI agents replacing repetitive work. They see automation in, QA and training and knowledge management. All of those are good things, but they certainly are seen by the analysts as attacking the revenue generation ingredients that the publicly traded companies have. If you got 10 million contacts that require 40% fewer humans than before, then revenue growth becomes much more difficult to attain. So I don't know that they're ready to bury the industry as much as they're ready to consider that its the future is a much slower growth and much harder curve down the road, in my view. I think a second one within why they're nervous is, arbitrage has been for 20 years a huge value play in the industry, and they've been able to offset revenue declines with margin increases that came with going offshore and going in through labor arbitrage. And I think the investors right now are not necessarily seeing that revenue is safe and that margins aren't necessarily growing in reverse proportion to revenue declines like it did with arbitrage. So, AI takes away arbitrage and how much profit can be made on an AI agent versus just another human being in another geography, which has been the staple of growth over the last 20 years or so. And as you mentioned before, there's really a lack of a compelling winning story right now from within the BPO industry. They love the analysts in the markets love AI, as mentioned before, but they don't like companies or industries that they perceive as victims in any respect. And there seems to be a large perception right now that the BPO industry is going to be a victim of AI versus being a beneficiary. And so far, the major players are all trying to convince the markets that they belong in that category of AI providers. And that's very difficult to do when they really don't belong in that category. They belong more in those that will partner with AI as opposed to being an AI generating company. I've never seen in the 30 years I've been in this industry that it's very, very rare. And I've never seen one company that would be willing to put 100% of their CX architecture in the hands of one player. And traditionally BPOs or enterprises rather have used BPOs in multiple ways and never relied on one single player. So I think that presents a really good challenge for the BPOs to meet going down the road. And then I guess the last one in relation to what you just asked was, public markets reward growth. And we're seeing growth drop off. We're seeing revenue growth percentages drop. And as mentioned before, we're really not seeing margins keep up or soar as a result of that revenue growth. And those two things, if they move in opposite directions, that can be a good thing. But if they move in the same direction and downward, that's not necessarily a good thing.
There's a couple of things that you discussed there that I think are important to tease out. And one of them is the extent to which you've got analysts, financial analysts, stock analysts who are great with numbers, but have, I would say, at best, a casual understanding or a moderate understanding about this industry and some of the narratives that are important and some of the different factors and how they all intermix with each other. Jim, from your perspective, how much of an influence are these analysts, whether it's in Wall Street or in the city in London or ones that are analyzing for different indices around the world? How much influence are they having in terms of the extent to which major funds, fund managers, or individual investors are choosing to get involved in investing in traditional CX BPO players?
Significant, I think, and certainly more than most of the operators want to admit. And not, I know we're confining this to the publicly held sector, but private equity is doing the same thing. They have a significant influence, and they have a significant influence in buying decisions of publicly held companies. And in an era right now where you're seeing a lot of consolidation, or the joke across the BPO space is every company is for sale. They just haven't sold yet, or they don't know it.
Yeah.
But they all seem to be, there's lots of consolidation taking place, in part because that's one way they're going to be able to retain the revenue numbers that seem to be popular with Wall Street. But yeah, definitely their chatter is more influential than I think a lot of companies want to admit. Unfortunately, most of them, as you pointed out, are financially oriented, and they're not call center experts or BPO industry experts or business process experts. They are money people, and they look at some figures probably disproportionately. And, they really love stories, as you pointed out a few minutes ago. And, the current story that they're hearing, at least, is AI reduces human labor. And since labor is the primary input for BPOs, investors jump to immediately that, oh, well, the BPO is losing value, right? And I think that's a significant factor in what's happening today.
But Jim, this bothers me to a very large extent because when you talk to people in the industry, and I'll go back to what we were chatting a little bit about at CXO a couple of weeks ago in Ottawa to do a shameless plug for the event.
Which was wonderful, by the way. One of the best
Thank you.
CX outsourcers I've ever seen. So thank you.
Well, thank you very much. And as a panel chair, you did a fantastic job talking to the futurists, and you being a futurist yourself, you were well placed on stage. But one of the things, the narratives that keeps coming out, and one of the narratives that we're picking up on in terms of some of the research we're doing of buyers is that both clients and BPOs seem to be reducing the emphasis on reducing labor on the front line, which is where we know that the bulk of the labor sits within an outsourcing operation. And they're talking about doing more on the back end, on the administrative end, on quality assurance, et cetera, which will have an impact on headcount, but not nearly, I think, the extent to which many people who are casual observers of our industry actually think.
I think you get to the fundamental question that you get to with that is really how do they recover, right? And when you say how do they recover, one of the aspects that they've been focused on is a significant amount of kind of owning the concept of human and AI orchestration together, which in my opinion is actually very smart, because if they think they're going to be able to become the overall enterprise end-to-end AI provider for an enterprise, I just don't have faith that enterprises are going to want to put all of those eggs in a single basket. So humans are going to be important going forward, just not necessarily to the same degree that they have been over the last 30 years. When you think of sales campaigns, you think of significant financial services, you think of healthcare, some of those more complex transactions, that's where humans are going to come in. And BPOs who recognize that, and enterprises who recognize that, and focus on how do we use AI to our advantage where it has its best strengths, particularly with transactional oriented things or basic inquiries, and then use AI and humans together. That's a strategy that seems to be a real winning one. And for me, that's one way they're going to recover. They're going to redefine, if they can redefine themselves as being not just a human company or a technology company, but they can blend themselves into some sort of a hybrid. I think they'll be better off. You and I talked in Munich a couple of years ago about if you were going to create a BPO today, or if you were a medium-sized to large BPO, what would you focus on? And I think one of the things you and I both talked about at the time was how do firms look forward strategically, not just to next quarter or the quarter after that, which is hard to do in publicly held companies, but how do you look strategically to help an enterprise that might not be using BPO today get their AI strategy in place, which will reduce headcount for them, but then the BPO could come in and pick up that headcount. Because if an enterprise went from having 5,000 CX agents to now only needing 1,000 CX agents, right? Just to make up numbers, why would they want to keep having contact centers, having the infrastructure, having all of those processes when that's not their core business? And it really gets back to why BPO was invented in the first place, which was the premise of, we are experts in customer experience. You are experts in your particular product. So let us handle your customers in accordance with your product, and you focus on product and marketing. In my opinion, this would be a great opportunity for BPOs to get back to that concept, but it's going to be a strategic move. It's going to take time to get there, and it's hard to do when you've got analysts breathing down your neck every quarter, and your stock price is where it is right now.
So let me ask you then, you alluded to non-publicly traded firms in our space a few minutes ago. From your perspective, Jim, does the current atmosphere favor privately held companies that are doing BPO front office work, given the fact that, yes, there is pressure from private equity, but at the same time, perhaps they've got a little bit more flexibility because they're not constantly chasing end of quarter and they're not chasing headlines in the financial press?
Absolutely, Peter. There's probably two aspects to that. One of which you mentioned, which is you're not living from quarter to quarter and stock price today versus stock price next Tuesday kind of thing. So you do have time to be a little more strategic and a little more deliberate in what you do. But I think one of the bigger aspects that goes with that is you really have more control when you think about it, because a publicly held company, if one analyst or one fund manager panics, they can sell a significant number of your shares in no time.
Yep.
And once you get the float out there in the marketplace, you've lost control over your shares for the most part, and you are much more likely to see those kinds of big swings that come when there's buyer panic or when there's major market panic or anything like that. Whereas even though a private equity firm may own a significant amount of your company, typically in a private equity engagement, the senior leadership of a company is directly involved with the private equity company on a day-to-day basis, or at least on a regular basis. And they're less likely to sell a significant portion of their stake on a day-to-day basis, because that's not how private equity works. They work on short and long-term liquidity events. And so you definitely don't have to worry about the day over day market indices, because, as you pointed out, you do have more time because it's not going to the public winds, but also because you have more influence in a private equity owned company, because you're actually talking to the people and helping them understand your business better, because they own a significant stake.
Kind of makes me that we're making a case now for publicly traded firms to consider going private.
Well, I think a case can be made for that,
Yeah.
and likely will be going forward. I'm no stock expert or financial markets expert, but you did see a couple of years ago, you saw one of the publicly held companies announce an initiative to go private. And while at this point they're still public, I think the sentiment out there is it certainly represents some thinking among all of the companies as to whether or not the days of being a publicly held BPO are worth it anymore.
Yeah, I have to say, as somebody who's been following our space for quite some time and followed the results of publicly traded outsourcing firms, but also followed some of the challenges and some of the restrictions that they've got, and almost some of these barriers they have to just acting quickly because of compliance and so forth. I almost think in certain ways, maybe a move towards the private side is just the right way to go in order to be a little bit more responsive to the marketplace. But look, that's another story for another day, Jim. I wanted to say a big thank you for joining us today. It's been a fascinating discussion, and I'm sure that this will not be the last time that we connect with you to talk about some of the more contentious and some of the more complicated issues in the CX space. You've got a great way of boiling things down and making them, I think, rudimentary and understandable for even the most casual observer. So thanks once again.
Thank you, Peter, for having me here. I appreciate it. If you don't mind, just in a wrap up, I work with BPOs and I work with enterprise companies, and in my opinion, for what it's worth, I do think the market, the public markets have overreacted quite a bit to the idea that contact centers will disappear, because I don't think they will, as we pointed out. But I also, when I work with BPOs, I advise them to think about a different definition, and the message of we're not just selling people anymore. We're selling customer outcomes delivered through good blends of AI, automation, analytics, people, etc. And as long as they can continue to evolve with that and not fall victims to the winds of Wall Street creating panic, I think the industry's got a future, but it definitely is going to be different than it has been over the last 2 or 3 decades. So thanks again for having me here, Peter. I really appreciate it, and letting me opine with you for a few minutes.
Thanks for listening to the CX Files podcast. We really appreciate your feedback and suggestions. You can reach myself, Mark Hillary, or Peter Ryan via LinkedIn. Please also leave a rating or review on your favorite podcast provider, as that helps more people to find us. As always, we'd like to thank Chris Haig at Traction Media for the CX Files graphics. See you next week.